Kraft Heinz, KHC, reported fourth quarter and full year financial results on February 21st. This video provides an update on the company's recent results and what to expect moving forward. First, let's discuss the company's actual financial results. Results for the fourth quarter were subpar, slightly missing consensus expectations on both the top and bottom lines. Organic net sales increased by 2.4% year-on-year. Adjusted earnings per share decreased by 6.7% year-on-year, from 90 cents in last year's quarter to 84 cents this year. However, it was not the company's top and bottom line financial results that caused us concern. Instead, Kraft Heinz included three troubling announcements in its earnings release. The first announcement was Kraft Heinz's significant write-down of goodwill and intangible assets. These are balance sheet assets that accrue over time when the company acquires companies at prices higher than book value. From the press release, during the fourth quarter, as part of the company's normal quarterly reporting procedures and planning processes, the company concluded that, based on several factors that developed during the fourth quarter, the fair values of certain goodwill and intangible assets were below their carrying amounts. As a result, the company recorded non-cash impairment charges of $15.4 billion to lower the carrying amount of goodwill in certain reporting units, primarily U.S. Refrigerated and Canada Retail, and certain intangible assets, primarily the Kraft and Oscar Mayer trademarks. These charges resulted in a net loss attributable to common shareholders of $12.6 billion and diluted loss per share of $10.34. Importantly, this write-down is a non-cash charge, which means that the company's liquidity and statement of cash flows is unchanged after this announcement. Still, the main message is troublesome. Two of Kraft Heinz's most important brands were not as valuable as they once thought. The second troubling component of Kraft Heinz's earnings release was the announcement of an SEC investigation into the company's procurement accounting. From the press release, the company received a subpoena on October 2018 from the U.S. Securities and Exchange Commission, the SEC, associated with an investigation into the company's procurement area. More specifically, the company's accounting practices, procedures, and internal controls related to its procurement function, including, but not limited to, agreements, side agreements, and changes or modifications to its agreements with its vendors. Following this initial SEC document request, the company, together with external counsel, launched an investigation into the procurement area. In the fourth quarter of 2018, as a result of findings from the investigation, the company recorded a $25 million increase to costs of products sold as an out-of-period correction, as the company determined the amounts were immaterial to the fourth quarter of 2018 and its previously reported 2018 and 2017 interim and year-to-date periods. Additionally, the company is in the process of implementing certain improvements to its internal controls to mitigate the likelihood of this occurring in the future and has taken other remedial measures. The company continues to cooperate fully with the U.S. Securities and Exchange Commission. Based on the messaging in the company's press release, it appears this investigation and the subsequent correction was due to errors and not misconduct. Still, this is something that investigators should be watchful of in Kraft Heinz's next several earning releases. By far, the most troubling component of Kraft Heinz's earnings release was the company's dividend cut. In conjunction with the earnings release, the company announced a dividend of 40 cents per share, which represents a $0.225 reduction from its previous quarterly dividend of $0.625. The company's CEO, Bernard Hess, made the following statement in conjunction with the dividend cut. We believe this action will help us accelerate our deleveraging plan, provide us strategic advantage through a stronger balance sheet, support commercial investments, and set a payout level that can both grow over time and accommodate additional divestitures. By doing this, we can improve our growth and returns over time. Dividend cuts trigger a sell rule using our systematic portfolio management system. In the final section of this video, we will discuss actionable next steps for investors who own the stock today. Before that, however, we wanted to take some time to discuss Kraft Heinz's current dividend safety. More specifically, we'll assess Kraft Heinz's dividend safety from two perspectives: earnings and debt, the latter of which includes an interest rate stress test. Normally, we would also include an analysis of the company's free cash flow, but Kraft Heinz has not yet filed its 10-K with the Securities and Exchange Commission, and the company does not include a statement of cash flows with the press release it publishes to its website. First, let's discuss Kraft Heinz's dividend safety in the context of the company's current earnings. When Kraft Heinz reported fourth quarter financial results on February 21st, the company announced that it generated adjusted earnings per share of 84 cents in the 3-month reporting period. Kraft Heinz's new quarterly dividend of 40 cents per share implies a payout ratio below 50% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Kraft Heinz generated adjusted earnings per share of $3.53 in the full fiscal year. Its new annual dividend payout of $1.60 implies a new payout ratio of 45% in the 12-month reporting period. With Kraft Heinz, the forward-looking outlook is much more important than its performance in the last quarter or year. Because of that, let's examine what might happen to the company's financial results in fiscal 2019. Kraft Heinz did not provide earnings per share guidance for fiscal 2019 when it announced its most recent financial results. With that said, the company did provide guidance for adjusted EBITDA. More specifically, adjusted EBITDA is expected to be between $6.3 billion and $6.5 billion in fiscal 2019. The midpoint of this guidance band, $6.4 billion of adjusted EBITDA, represents a decline of 10% from the same period a year ago. If we apply the same negative growth rate of Kraft Heinz bottom line, the company should generate adjusted earnings per share of about $3.18 in fiscal 2019. Using the earnings estimate, the company's payout ratio in the next fiscal year would be 50%. Even with this expected decline in earnings, Kraft Heinz dividend appears well covered by its earnings, and we do not expect another dividend cut in the near future. The second angle that we will use to assess Kraft Heinz's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its earnings would no longer cover its dividend payment. At the end of fiscal 2018, Kraft Heinz had $31.3 billion of total debt outstanding. The company generated $326 million in interest expense in the most recent quarter for a weighted average interest rate of 4.2%. Separately, Kraft Heinz is likely to generate adjusted net income of $3.9 billion in fiscal 2019, which represents a 10% decline from its 2018 figure of $4.3 billion. Lastly, the company's new annual dividend represents $2 billion of shareholder distributions per year. Using these assumptions, the following image shows how changes to Kraft Heinz's weighted average interest rate would impact the company's dividend safety as measured by adjusted net income. As you can see, Kraft Heinz weighted average interest rate would need to rise to above the 10% level before its dividend would no longer be covered by free cash flow. Because of this, The company's debt looks unlikely to impact the safety of its dividend in the near future. Kraft Heinz is a remarkable business. The company generates about $6 billion of operating income from about $7 billion of tangible assets, a record that few companies can match. With that said, Kraft Heinz clearly overextended its balance sheet. Even after the significant write-down in the most recent quarter, the company still has $36.2 billion of goodwill on its balance sheet and $49.7 billion of other intangible assets. The company's $40 billion market capitalization shows that investors need to pay significantly more than its $7 billion in tangible assets to buy a piece of Kraft Heinz's underlying earnings power. Overall, Kraft Heinz' fourth quarter earnings release has caused us to make significant revisions in how we value the business. As Warren Buffett noted in the interview with CNBC's Squawk Box earlier this week, Kraft Heinz simply isn't worth as much as it has been in the past. We were previously estimating fair value for Kraft Heinz of around 16 times earnings, but are revising the estimate downwards to a price-to-earnings multiple of 11. Overall, Kraft Heinz remains undervalued. Because of this, we recommend investors continue holding Kraft Heinz and wait to sell the security until its price approaches fair value, which we estimate at around $39. Thank you for watching today's video, which performed a deep dive on Kraft Heinz's recent financial results and current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.